So I'm Joshua Dalton, and I'm a part of Modern Money Australia. I hope you can all see me and hear me. We've had some technical issues, so I apologise if my audio is a little interrupted at the moment. So today we're hosting Dr. Stephen Hale from University of Adelaide, who'll be presenting on what quantitative easing is and giving the MMT perspective on quantitative easing. So before he begins today, I'm just going to give a little rundown of how the presentation will go, and then I'll pass the baton on to Stephen. So to begin with, I'm just going to briefly explain what Modern Money Australia is for anyone who hasn't encountered us before. We are a incorporated nationwide association that is built around trying to promote an awareness of and an understanding of monetary theory and the policy space that it offers our national government in order to pursue various social and public goals. So we also have a variety of social media platforms where we share information about modern monetary theory in terms of news articles and informed analysis. We have our YouTube channel where our previous in-person presentations have been uploaded to in case you've missed any presentations or you'd like to learn more about modern monetary theory. We also have a Facebook page and a Twitter account. With the structure of today, once I finish my presentation, pass on to Stephen. Afterwards, we'll have a Q&A session. If you would like for your questions to, if you'd like to ask a question rather, and have it be answered, you will see at the bottom there is a little Q&A section. Please type your questions into that section there and not the chat, because we will miss any questions that are in the chat. Beyond that, I don't think there's too much else I want to say. So again, I just want to welcome Dr. Stephen Hale, and I will let him now talk about quantitative easing. Thank you, Stephen.
Well, thanks very much, Joshua, and thanks everybody. I think what I'll do first of all is I'll just share my screen. Hopefully this will work. With a bit of luck, everybody should be able to see that, I hope. Thank you very much for inviting me. I must admit, this feels a bit strange. First of all, I would never have dreamt until very recently that loads of people would ask me to talk about, oh, I'm having a few problems getting things out of the way of the slides, would ask me to talk about quantitative easing on a Saturday afternoon. That's great, but for somebody who's been teaching money and banking for years, it does seem a bit bizarre, but these are strange times. And secondly, it'll take me a few minutes to get into my stride because I'm used to running around all over the place when I give talks, and my brain doesn't always work so well when I'm sitting in one place, which is what I'm doing at the moment. But we'll do the best we can to address the titles you can see on that first slide there. Quantitative easing, I've put it in inverted commas because quantitative easing in Australia doesn't mean exactly the same as it means as it has meant in some other countries down the years. The story so far, I was a little bit delayed in getting to you. I thought I might be a bit late clicking on if it had taken me any time to get through, because I was just double checking some of the most up-to-date statistics. So that when I say talk about the story so far, I mean right up until now. Anyway. Here are some questions you might have as far as quantitative easing is concerned. First of all, what is it? Secondly, is it, as you sometimes hear people say on the internet, free money for banks? Is the central bank just funneling cash into the private banking system to generate banking profits? Are the banks getting something for nothing? Does quantitative easing lead to more lending by banks automatically? Does it increase the money supply by a multiplied amount by enabling banks or encouraging banks to do a lot more lending? How does quantitative easing differ from what the Reserve Bank normally does, or what the Reserve Bank was doing across its history up until the 18th of March? What, if anything, does quantitative easing achieve? Why is the Reserve Bank doing it anyway? And then what's the link between quantitative easing and fiscal policy? Indeed, I just happened to see, I clicked quickly on the Q&A section, I happened to see somebody asking a question, what's the link between quantitative easing and government debt? We'll try and deal with that as well. So here we are, the Reserve Bank Board. The Reserve Bank Board has 9 members on it. That includes the ex officio members who are normally appointed for terms of 7 years, which can be extended. The Governor, Philip Lowe, the Deputy Governor, Guy Debelle. And in case you think that the government's not represented on the RBA board, they are. The Treasury Secretary, Stephen Kennedy, is on the RBA board. And there are 6 others too, from the private sector, occasionally from universities as well. And they meet on the first Tuesday of every month, normally, except January. And they make a decision about something called the target cash rate, whether to increase it, or in recent years, it's largely been to reduce it over time. When they do this, they are supposed to be focusing predominantly on the Reserve Bank's inflation target, which is to keep the inflation rate within the range of 2 to 3% per annum in the medium term. In other words, looking 2 or 3 years ahead. They have missed that inflation target on the low side almost the whole time for the last 4 years. And as I'm going to show you, in case you're unaware of this, interest rates in Australia have been on a long run downward trend for longer than that. There's Philip Lowe at the top. There's Guy Debelle in the middle there. Guy had a long conversation with Stephanie Kelton when she was in Australia. I wasn't there for the conversation. I can't tell you what they talked about because I missed a flight, otherwise I would have been. And well, you can see Stephen Kennedy, he's the guy in the bottom picture next to Philip Lowe, and they are both standing in front of the person who is, well, effectively both their bosses, but directly, really, Stephen Kennedy's boss, of course, the Prime Minister, Scott Morrison. The 18th of March was an emergency meeting. Obviously, it wasn't the first Tuesday of March. They'd already had the March meeting. But between the beginning of March and mid-March, as we know, the coronavirus epidemic had become even more significant than before. It had become a crisis. And so the Reserve Bank had an emergency meeting to do its bit to support the Treasury in supporting Australia's economy, and that led to some unprecedented decisions. Those unprecedented decisions were that they reduced the target cash rate, which is what they normally talk about, from 0.5%, which was already the lowest level it had ever been, to 0.25%. This is a little bit confusing because I'll talk about what the cash rate represents in a moment, but one of the other decisions they took guaranteed that they would miss this target. So it's rather unusual for a policy institution like the Reserve Bank to announce a target for an economic variable and at the same moment announce a policy which would lead to them quite deliberately missing the target on the low side. As some of you might already know, the Reserve Bank offers banks a facility where if those banks run an overdraft at the RBA, they pay the RBA the target cash rate plus 0.25%. So that was reduced as well. If a bank was running an overdraft at the RBA, now they'd be paying the RBA a 0.5% interest rate. And up until now, the RBA has paid interest on bank exchange settlement account balances. That's the deposits that the banks have at the RBA, which are used to facilitate those interbank transactions, which allow our economy, our monetary system to run smoothly over time, at 0.25% below the target cash rate. Well, that ought to have meant that once they cut the target cash rate to 0.25%, they shouldn't be paying interest at all on bank exchange settlement account balances. But they've given the banks a little bit of a subsidy, you might say, in they've not cut the interest rate they pay on exchange settlement account balances down to 0. They've cut it to just 0.1%. So not 0.25% below the target cash rate, but 0.15% below the target for the cash rate. They introduced something called a term funding facility, which is a subsidy, basically cheap lending by the RBA to the banks based on the amount of lending that the banks have already undertaken and undertaking in the future as far as businesses are concerned, particularly small businesses. That's so far not quantitatively important, so we won't worry about that. And the other thing they've done is to introduce for the first time in Australia a quantitative easing policy. This quantitative easing policy involves the Reserve Bank buying a range of Commonwealth government bonds and some bonds issued also by state and territory governments as well, with a target to drive the prices on those bonds up far enough so that what finance people call the yield to maturity on those bonds, what we might call the interest rate on those bonds, is driven down, as it has been already. They've been successful in doing this, to 0.25%, basically to the target cash rate. This puts downward pressure on long-term interest rates in Australia. And it also conveys to financial markets the RBA's intention to leave the target cash rate at 0.25% for at least 3 years. But there's not going to be an increase in official interest rates anytime in the foreseeable future. The RBA has never done quantitative easing before, and indeed quantitative easing had never been done before in modern times until it was introduced in Japan in 2001. The US Fed, the Federal Reserve, introduced quantitative easing immediately after the global financial crisis broke out in 2008. The UK followed suit in 2009. And the European Central Bank eventually implemented a quantitative easing policy itself in 2015. It involves the creation of large amounts of exchange settlement account reserves. It involves, as I was just saying, the central bank in Australia, the Reserve Bank of Australia, buying large amounts of government bonds from banks and also non-bank investors like insurance companies. This creates a lot of additional reserves in the banking system, exchange settlement account reserves. That's basically how the central bank pays for these bonds, which it's purchasing, just using a computer keyboard to type additional funds into bank reserve accounts. I've said at the bottom here, but perhaps we'll dwell on this a little bit later. We've got a lot of evidence on the impact that quantitative easing has on financial markets and more broadly on spending on goods and services and on the real economy. And that evidence is that even when it's done on a huge scale, and it's been done on a vast scale down the years in Japan, and to an extent in those other three countries, if you're going to call the Eurozone a country, the US and the UK and the Eurozone too, it's had a limited impact on financial markets. Central banks can control long-term interest rates. This does have an effect on the stock market, for example, but at most a very weak one on the real economy. And we might, that would be relevant when we come to think about why do you want to do it in the first place. Here's what the Reserve Bank's been doing as far as Commonwealth government bonds and state and territory bonds are concerned. They announced the policy on the 18th of March. They started buying these bonds on the 20th of March. This chart is not quite up to date, but very nearly. You can see from the black line there that the total purchases of Commonwealth government and state and territory government bonds are over $40 billion now. On this chart, $7 billion of that was state and territory government bonds. Actually, they've purchased another $1.5 billion of those in the last couple of days. And the red line here, well, that's RBA purchases of Commonwealth government bonds. They bought another $1 billion worth of Commonwealth government bonds in the last couple of days as well. So this line is still going up. In case you're interested, they owned about $15 billion worth of government bonds before introducing quantitative easing. So the extent to which the Reserve Bank of Australia owns government bonds has hugely increased in the last 3 weeks. This is not helicopter money. Quantitative easing has nothing to do with helicopter money and really not much to do with the notion that there's a magic money tree out there. The Reserve Bank is not giving away money to the banks for free. The Reserve Bank is not allowed to give stuff away for free. The Reserve Bank can buy and sell certain financial assets, including, as is obviously the case, Commonwealth government bonds and state and territory government bonds. And they also trade to a limited extent in some private sector securities as well. And the Reserve Bank can lend to our private sector banks and certain other financial institutions as well. But the RBA cannot give money away. The RBA cannot make welfare payments. Only the government can do that, subject to parliamentary authority. That's fiscal policy. The Reserve Bank cannot change the net financial assets of the private sector. Only the government can do that. As I said, subject to parliamentary authority. That's fiscal policy. That's the job of Scott Morrison and Josh Frydenberg. It's not the job of Philip Lowe. Quantitative easing is not free money for banks. Obviously, what the RBA is doing is it's buying government bonds from banks. So sure, it's putting funds into banks' exchange settlement account balances, the accounts that the banks have at the RBA, but that's in return for government bonds which the banks previously owned, that the banks will not own anymore because the RBA has purchased them back. So it's an asset swap. It has implications for asset prices. If the RBA buys a lot of government bonds, it drives the prices of those bonds up. Just like if there was a huge demand for anything, it drives the price of whatever you're talking about up. If the RBA decides to buy sufficient quantities of government bonds, it's going to drive the prices of those bonds up, and higher bond prices means lower interest rates on bonds. Now, if bond prices are driven up as a result of quantitative easing by the RBA, if you owned government bonds prior to the RBA engaging in quantitative easing, you're certainly going to make a capital gain from this, so you'll make a profit from it, but that's a side effect. Driving the prices of government bonds up, putting downward pressure on interest rates or yields on government bonds is the RBA's intention. The fact that some institutions will make a trading profit as a result of this is not the intention, it's a side effect. As far as the magic money tree is concerned, I suppose you can at least say that quantitative easing makes explicit something which was always true implicitly, which is that our consolidated government sector cannot ever run out of Australian dollars. This was always true. It's now more obviously true because it's true. It's obvious to everybody that all the RBA is doing is using a computer keyboard to pay for these government bonds that it's buying. But it's an asset swap, and you shouldn't expect it to be particularly inflationary or at all inflationary, really, because you're just swapping apples for very similar apples. Government bonds are interest-bearing liabilities of the consolidated government sector, while exchange settlement reserves, remember the RBA pays interest on them, albeit at the moment only at 0.1%, but they're also interest-bearing liabilities of the consolidated government sector. So the difference between government bonds and exchange settlement reserves at the RBA is not a huge one. When banks and other investors own government bonds, basically they own transferable term deposits at the RBA. That's all government bonds are. If the RBA buys those government bonds and credits banks' exchange settlement account balances, and this will happen, although I don't want to go through the mechanics of it, even if the RBA is buying these government bonds from non-banks, it's the same overall effect. It still increases exchange settlement account reserves for banks. All that's happening is they're converting a term deposit at the RBA into a transaction account at the RBA, nothing else. It's not a gift to anybody. Where are these exchange settlement account reserves coming from? From a keyboard like the one I'm sitting behind at the moment. What's the impact of this on exchange settlement balances? Remember what they are. They're our bank's transaction accounts at the RBA, used for a variety of purposes, most importantly used for interbank transactions resulting from the clearing of the millions of transactions that take place in our economy every day. Now, I've simplified things a bit here. I've stripped out from this data some artificial exchange settlement accounts, some data on the RBA site which relates to changes in our payment system, which have been implemented in the last few years, which are not genuinely exchange settlement balances at all. So if you want to go onto the RBA site, look at the data, it won't look exactly like what you can see on the slide in front of you now. On the slide in front of you now, you can see that the level of exchange settlement account balances that our banks were holding up until March 2020 was a very low level. Well, exchange settlement account balances are not profitable to hold. You get an interest rate on them, which is below the target cash rate. It's a below market interest rate. So banks historically have minimized the extent to which they hold exchange settlement account balances. If as a result of transactions taking place on a particular day, there is a net outflow from Westpac's exchange settlement account balance and a net inflow into the Commonwealth Bank's exchange settlement account balance, then the system can continue to operate even though neither bank has very high levels of exchange settlement account balances, because the Commonwealth Bank can lend those funds back to Westpac overnight at the cash rate. That's what the cash rate is. The cash rate is not a rate of interest at which the Reserve Bank lends to anybody. Neither is it the rate of interest, as I've already said, that the Reserve Bank pays on bank exchange settlement accounts. Instead, it's the average interest rate at which the banks lend to and borrow from each other overnight or for 24 hours. And under normal circumstances, the banks don't need to hold very much in the way of exchange settlement account balances. And what the RBA has done down through the years is it's made sure that the total amount of exchange settlement account balances in the system is whatever the banks collectively wanted to hold, given the current level of the target cash rate. That's how the RBA has held the cash rate at its target level, ensuring there's not a surplus of exchange settlement account funds in the system or a shortage. What changed in March? Well, first of all, banks, as we go into a crisis and they're less sure that they're going to be able to borrow funds overnight, demand more exchange settlement account balances. So the RBA supplied them early on in March. Exchange settlement account balances increased significantly in terms of value before quantitative easing was implemented, just using the traditional approach that the RBA has had to putting additional reserves in the system, which I'll remind you about in a minute or two. But then we had quantitative easing, and you can see as a result of quantitative easing, as a result or almost exclusively of those very large scale purchases of government bonds I was talking about before, the exchange settlement account balances in the system have gone up enormously. What's happened is, if you're a banker, you'd say the Reserve Bank's balance sheet has expanded enormously. The RBA now owns far more government bonds than the RBA used to own. So the RBA's got more assets than it had before. The banks have far more in exchange settlement account balances at the RBA than they had previously. So the RBA has more liabilities too. The two sides of the balance sheet, of course, have to balance, but it's an expanded balance sheet like that. Increasing bank exchange settlement account reserves like this, what does that mean? It means that the banks have a lot more electronic cash than they did before. Some people think might be inflationary because it might mean the banks can suddenly go and do a lot more lending. If you've studied first year economics in a conventional way, at a normal university, you've probably learned about something called the banking multiplier. If the banking multiplier was anything other than a myth, then hugely increasing banks' exchange settlement account reserves, as I've just described here, and as we've already said, has been done in other countries, in Japan since 2001, in the other countries more recently, on an enormous scale, would have been hugely inflationary. But it's not, because in our monetary system, for reasons that I won't explain today, but some of you might be aware of already if you've taken much of an interest in modern monetary theory, bank lending is not restricted by the amount of reserves that banks hold anyway. When banks lend to you and I, of course, they create a loan, which for the bank is an asset, but they also create a deposit on which we can draw, which is the bank's liability. At the time the banks engage in lending, they don't need additional reserves. They only require those additional exchange settlement account reserves when funds are transferred from one bank to another. And as I've said, banks that are short of reserves under normal circumstances borrow those reserves from banks with surplus reserves overnight anyway. So putting more reserves in the system does not directly encourage additional lending by banks, because the banks could have done the extra lending anyway. There are limits on the ability of banks to lend, some of which are to do with APRA and banking regulation. Others are to do with finding creditworthy customers that are prepared to pay high enough interest rates for banks to make a profit on lending. But those limits are not a lack of exchange settlement reserves. So putting more reserves in the system doesn't encourage banks to lend more. What it does do, as I've already said, is it puts upward pressure on bond prices. That puts downward pressure on the interest rates on bonds. So quantitative easing involves the RBA not just concentrating on controlling the overnight interest rate or cash rate, which is what they've done down the years, but involves the RBA focusing on longer term interest rates. In this case, putting downward pressure on long-term interest rates. And I didn't say before, but they had this specific target of pushing the interest rate on 3-year Treasury bonds down to 0.25%. Lower interest rates on government bonds puts downward pressure on the interest rates on corporate bonds too. So it makes it easier for companies to raise money by issuing bonds. And it also provides an incentive for fund managers to change their portfolio decisions so that they move out of government bonds, because the return on government bonds is now so low, and into higher risk assets. So it can have an effect, and in the US certainly did have an effect on the stock market, because fund managers move out of bonds and into shares. That puts upward pressure on share prices. That might make people feel wealthier, those people that own those shares, and that might encourage additional spending in the economy. Well, you can see why I said quantitative easing has an indirect and very weak impact on economic activity, even when it's done on a huge scale. But the RBA certainly can, if they want to, deliver a target, as they already have, for the interest rate on 3-year Treasury bonds, because they can just keep buying Treasury bonds until they hit that target. And they've, as I said, they've already managed to do that. In the case of Japan, for the last 4 years or so, they've had an explicit target for the interest rate on 10-year government bonds, and that target in Japan has been 0. And they've persistently hit that target too, just by having the Bank of Japan buy lots of Japanese government bonds. Okay, well, what's happened to the cash rate? It's been reduced twice this year, and in the long run, there's been a downward trend in the cash rate towards 0. Up until very recently, We didn't even bother distinguishing between the Reserve Bank's target for the cash rate and the actual cash rate at which private banks actually were lending to and borrowing from each other overnight. That is because in the last 20 years, the gap between these two interest rates has never been more than 1 or 2 basis points. That's 1 or 2 hundredths of a percent. Basically, they've always been the same thing. The Reserve Bank, by fine-tuning the supply of cash to the banking system, fine-tuning the supply of exchange settlement account balances, so that there was never a shortage, but also never a surplus in the system, have been in a position to hold the cash rate at their target level. But look what's happened since the 20th of March. Since the 20th of March, the target for the cash rate has been 0.25%, which is what they decided on the 18th of March. They have now hit that target as far as the interest rate or yield on 3-year Treasury bonds is concerned. They've not just bought, remember, 3-year Treasury bonds. They've bought Treasury bonds across a variety of maturities out to about 10 years. And they've bought state and territory government bonds too. But because these assets are close substitutes for each other, they've been able to deliver on their target for the yield to maturity or the interest rate on 3-year Treasury bonds by doing this. But look what's happened to the actual cash rate. The cash rate has been driven below target. Why has it been driven below target? Well, it's been driven below target because it's the interest rate on overnight or 24-hour interbank loans. What are they lending to each other? Exchange settlement account balances. What's happened to the supply of exchange settlement account balances in the system? It's hugely increased. What's the consequence of this? Well, the consequence of this is that there are far more banks in Australia that have surplus exchange settlement account funds, which they're getting 0.1% on from the RBA, in which they'd like to lend overnight at a higher interest rate, than there are banks which have a shortage of exchange settlement account funds that need to borrow overnight. And under these circumstances, when there's an excess supply in the overnight money market, when there are more banks looking to lend overnight than there are banks wanting to borrow, you'll see the cash rate fall. And if the Reserve Bank does nothing about this, and of course they've been encouraging this by putting more cash in the system, then the cash rate will fall below the Reserve Bank's target. On this chart, it went down to 0.17%. This chart's a couple of days out of date. The cash rate is now 0.15%. There are still banks that are borrowing overnight from other banks on Australia's money market, but they are now doing that at a rate of interest which is well below the so-called target for the cash rate. Let me just remind you how things used to work. Before the 18th of March, Reserve Bank monetary policy decisions and the way in which they were implemented, the way the Reserve Bank delivered on its decisions for the target cash rate had been consistent since 1993. They're always supposed to have been looking to deliver that 2 to 3% inflation target. The tool for delivering the target was the target cash rate. They meet on the first Tuesday of each month. And at that meeting, they're supposed to decide whether to put the target for the cash rate up, which you do if you thought spending was out of control and inflation was accelerating and you needed to bear down on inflation by discouraging borrowing and spending in the private sector. Or, and of course, they've been doing this most of the time in recent years, put the target for the cash rate down if you're worried that the economy is not growing quickly enough, there may be a recession, unemployment is too high and might be rising, and you're worried about it missing inflation on the low side. The cash rate, I've already defined that. It's the annualized rate of interest paid and received by private banks on overnight loans of exchange settlement funds. The RBA, until the 18th of March, for at least 20 years, has delivered on its target for the cash rate continuously, including during the global financial crisis, with a very high level of precision. The cash rate has always been at the Reserve Bank's target. How did they facilitate this? Well, part of it involved the use of a corridor system, which I've already described to you for interest rates. Until the 18th of March, the RBA paid interest on bank exchange settlement account balances at 0.25% below the target cash rate. This gives banks holding more exchange settlement account reserves than they need an incentive to lend out those exchange settlement account reserves at the cash rate rather than just keeping on deposit at the RBA. And if banks, and this hasn't happened very often, but if banks have run an overdraft at the RBA, then the RBA has automatically lent to them overnight at an interest rate 0.25% above the target cash rate. Well, this obviously gives banks an incentive when they're running short of exchange settlement account funds to borrow those funds at the cash rate because it's cheaper than using the overdraft facility at the RBA. So we've had a corridor system. The Reserve Bank has managed to hold the cash rate at its target level because banks holding more exchange settlement account reserves than they need have an incentive to lend those reserves because they'll get 0.25% higher interest rate if they do that. And banks running short of exchange settlement account reserves have had incentive to borrow them overnight from other banks because it's cheaper than borrowing them from the RBA. And as you can see, and this goes back to the millennium, 20 years or so ago, the average interest rate at which banks lent to or borrowed from each other was not always precisely equal to the Reserve Bank's target. But as the banks have got more used to the system, and as the RBA has got better at managing the supply of cash to the banking system over time, you can see that gaps between that point that I'm just, I've got the arrow focusing on now from 2009 was where they missed their target by 0.01%, by 1 basis point. We've got used to saying in the last 10 years or so that the RBA just sets the cash rate because the cash rate and the Reserve Bank's target for the cash rate have always been the same thing. And when the Reserve Banks decided to change interest rates, for example, when they reduced the target cash rate from 1.5% to 1.25% a few years ago, then all the RBA had to do was announce a reduction in its target, and the cash rate that the banks used to lend to and borrow from each other automatically followed the target down because the whole corridor shifted down, and that system of incentives that I mentioned before remained in place. And the idea has been you reduce the cash rate because by reducing the cash rate, well, if you reduce the interest rate on overnight interbank lending, then money market interest rates, short-term interest rates in general will fall more or less in line with the cash rate, and longer-term interest rates, like the interest rates people pay on mortgages, although they don't move one for one with the cash rate, they also move in the same direction and on average over time by roughly the same amount. So by changing the cash rate, the Reserve Bank is able to influence the structure of interest rates in general in our economy. It can certainly do that. The next step here, as in terms of the transmission mechanism for monetary policy, as the RBA describes it, is a much weaker one. Modern monetary theory economists like me, and maybe like you too, point out that there is no evidence of a stable and reliable relationship between movements in interest rates and movements in total spending in the economy and output and employment and inflationary pressures historically. And one reason for this is, of course, that when they cut interest rates, a factor that they're relying on in order for lower interest rates to feed through into an increase in spending and higher economic activity is people taking out more loans from banks. But as we and going ahead and spending as a result, including mortgage loans and driving up property prices. But as we often point out, that's a sugar hit for the economy at best, because once those funds are borrowed, then households have more debt. than before, which is going to restrain their future spending. It might encourage more spending now. It will restrain future spending. Interest rate cuts, of course, benefit people who already have mortgages because they don't have to pay as much in mortgage interest, so they're better off. But on the other hand, people who have savings in the form of term deposits lose out. So the cash flow effect isn't so strong either. And there are other potential impacts. Lower interest rates may put upward pressure on the stock market, at least temporarily, might put downward pressure on exchange rates and so help exporters, at least temporarily. But monetary policy has an unreliable, an indirect, and sometimes when there's a lot of household debt already, a very weak or even perverse impact on total spending and economic activity. And in recent times, interest rate cuts have even been seen in a negative light because of the fact that they're a sign that the RBA is even more pessimistic about future economic conditions than they are before, which of course can cause people to spend less, not more. In order to control interest rates, as I said, in order to keep the cash rate at the Reserve Bank's target, the RBA has had to ensure that the level of exchange settlement reserves in the system has been equal to what the banks collectively have wanted to hold. And over time, the demand for reserves in the system varies from day to day, in part because of transactions which are expected to take place in the near future between the government or the RBA and the private sector. So flows of funds from the private sector to the RBA or the government create a shortage of reserves. For example, if the RBA has put some reserves into the system a few weeks ago, which the banks are now having to pay back, then that's going to create a shortage of reserves in the system today. If the RBA didn't add those reserves back into the system again, then there'd be a shortage of reserves and the cash rate would rise above the Reserve Bank's target. On the other hand, deficit spending by the government, for example, would put reserves into the system. If the government spends more than it taxes, then that involves the government making a deposit of funds in the banking system, and that increases banks' exchange settlement account reserves. And the macroeconomic function of bond issuance by the government, at least up until the 18th of March, was to withdraw these reserves from the system again to ensure that there were not an excess level of reserves in the system to hold the cash rate at the Reserve Bank's target. Most of the time, the RBA has aimed to keep the banking system a little short of reserves and just to keep topping the reserve balances of the banks up for over short periods of time, so that they had to keep rolling over this practice, lending reserves into the system for a few days at a time, so that the terms under which the RBA was prepared to put those additional reserves into the system to top up the reserves in the system to prevent there being a shortage of reserves would give the RBA the leverage to hold the cash rate at its target level, as I was just describing. What quantitative easing involves is the RBA moving away from this and deliberately putting massive amounts of excess reserves in the system, which is why the cash rate has gone below the Reserve Bank's target, as I was just saying. How does the Reserve Bank traditionally feed additional cash into the system to prevent there being a shortage of reserves, to ensure that there are just sufficient reserves in the system for the cash rate to be at the RBA's target level? They engage in what the Reserve Bank calls reverse repos. Now, a repo transaction in finance is where you buy an asset from someone else, from a counterparty, and at the same time, a repo is when you sell an asset to a counterparty, at the same time agree to repurchase it later, hence the term repo. What the Reserve Bank does when it puts additional cash into the system using reverse repos is to do the opposite. The RBA provides electronic cash to the banks today, buying bonds from the banking system today. And when they engage in these reverse repos, they don't just buy government bonds, they buy some private sector securities as well. But these purchases are not quantitative easing, they're not outright purchases of bonds, because at the same time, the RBA is agreeing to resell the very same bonds back to the banks that it deals with in a few days or a few weeks' time. And when they resell those bonds, again, the price that the banks pay for the bonds when they purchase them back from the RBA is higher than what the RBA pays the banks in the first place. So effectively, this is a secured loan. The Reserve Bank of Australia lending funds to private banks for a number of days, just topping up exchange settlement account balances to keep the cash rate at its target level, dealing with those banks which offer the RBA the highest interest rates. They're doing this in a legal sense by temporarily buying government bonds and other assets from the banks, reselling them to the banks in a few days or a few weeks' time at a higher price. The gap between the prices is what determines the interest rates that the banks pay on these reverse repo loans, as they're called. I've probably gone into a little bit too much detail there. Basically, what the Reserve Bank is doing is it's continuously over time lending cash to the banks, those banks that offer it the highest interest rates. And it's doing this deliberately every day just to keep the banking system topped up with enough reserves so that the cash rate is equal to the Reserve Bank's target, but not creating excess reserves in the system so that the cash rate doesn't fall below the Reserve Bank's target. Quantitative easing announced on the 18th of March, starting on the 20th of March, changed this practice. It involved the Reserve Bank buying outright large amounts of government bonds, deliberately putting excess cash reserves into the banking system and topping up exchange settlement account balances, as I was saying before. Well, the problem with what the RBA has been doing down the years is they've been cutting interest rates to encourage more spending because they've been missing their inflation target on the low side, and unemployment's been higher than they've believed to be desirable, of course, a lot higher than you and I believe to be desirable, and it's just not worked very well. Monetary policy, the use of lower interest rates in order to stimulate more spending, is never reliable. It sets up, I mean to say, not steps up, it sets up future problems because you are loading up households with additional debt, and it fails when you need it. It doesn't add to the net financial assets of the private sector. Only fiscal policy does that. Fiscal policy puts money into the economy which the private sector hasn't had to borrow into existence and so doesn't have to repay. Fiscal policy works if you want to stimulate more spending. Monetary policy can do so temporarily, but is unreliable, and it becomes less and less reliable the more and more debt that already exists in the private sector. Either because interest rate cuts and financial deregulation have built up so much private debt that you get to the point where interest rate cuts no longer work at all, or because people have good reason to be so pessimistic about the future, and of course there's a touch of this now, that nobody wants to borrow for investment or consumption anyway. And so you can cut interest rates and cut interest rates and cut interest rates, and you get to as low an interest rate as you're prepared to go. Now, we used to talk about a zero lower bound for official interest rates. And then after 2013 in Japan and in the Eurozone and in some other places like Denmark, they cut official interest rates, so they ended up being negative. Well, that didn't help either. The RBA has said that 0.25% is as low as they're prepared to go as far as the target cash rate is concerned. And they've said that they don't think there's any purpose in even considering negative interest rates. So for them, once they cut the target cash rate to 0.25%, they'd reach their effective lower bound. Conventional monetary policy had run out of bullets. It had gone as far as it could go. And there you can see the cash rate target. I took this off the RBA site, off their chart pack. They used to have a chart that just said the cash rate on it. You notice it now says the cash rate target on it because the Reserve Bank's target for the cash rate and the actual cash rate, as I've already mentioned, are not the same thing anymore. But you can see what I mean by there being a long run trend for the cash rate to fall, and by it having reached its effective lower bound. And there's not really anywhere further to go if you're going to dismiss a negative target cash rate. So what do? Once you've cut the target cash rate to 0.25%, the floor rate, the rate of interest you pay on exchange settlement account balances, it should have been cut to 0 if they kept the same corridor system as before. It hasn't been, it's been cut to 0.1%. You've implemented this term funding facility, which is basically some cheap funding, as I mentioned, for banks, but in terms of how much it's been taken up by the banks so far, it's not had a significant quantitative effect, at least not yet. And you've introduced a form of quantitative easing. Now, in Japan, as I've mentioned before, the Bank of Japan buys government bonds, and the Bank of Japan buys a lot of other things too. They've even been buying equities in Japan, with, amongst other things, the aim to have an interest rate of 0 on 10-year government bonds. In the Eurozone and in the US and in the UK, they've bought government bonds, mortgage-backed securities, corporate bonds as well. They've not had a specific target interest rate. Instead, they've announced the scale at which they were going to buy these bonds every month. In Australia, a little bit like Japan, I suppose, the RBA said, well, we'll just buy whatever volume of bonds we need to hit this interest rate target for 3-year Treasury bonds. Now, the term funding facility would increase the supply of exchange settlement reserves if banks wanted to take it up. It's mainly quantitative easing we're talking about. It's boosted the supply of exchange settlement account reserves, indicating that the RBA wants longer term interest rates to be at 0.25% at its target cash rate, and that the target cash rate's not going to be increased for at least 3 years. If the increase in the supply of exchange settlement account reserves has just matched a big increase in demand for cash from banks in uncertain times, then the cash market would still work as before. The cash rate would still be 0.25%. The cash rate would not have fallen below target. But as we know, delivering that target for the interest rate on 3-year government bonds has involved increasing the supply of exchange settlement account reserves hugely, so that it's begun to far exceed what banks need. As a consequence of this, as I've already mentioned, you'd expect not many banks to need to borrow cash overnight. So you'd expect the cash market to shrink, both in terms of the number of transactions taking place and the turnover. And you'd expect the cash rate to fall below the RBA's target. It can't fall below 0.1% because there's no incentive for a bank to lend exchange settlement funds to another bank overnight at an interest rate below what the RBA itself is paying. But you'd expect to see the cash rate falling below the RBA's target of 0.25% and moving towards that floor rate of 0.1%. And that's exactly what's been happening on this graph, which is a few days out of date, which I showed you earlier on in the presentation. The cash rate had reached 0.17%. Well, we've had 2 days since then. On Wednesday, the cash rate of 2 days worth of data. On Wednesday, the cash rate was 0.16%. On Thursday, the cash rate was 0.15%. This is the average rate of interest on that overnight market where banks and other authorized deposit-taking institutions lend exchange settlement funds to each other. Some small banks are still borrowing cash overnight, but they're borrowing cash overnight at an interest rate well below the so-called target cash rate. Well, this, on the face of it, is confusing, or it was when it was introduced, because as soon as they announced the policy, I thought, and my colleagues were thinking, they've announced a target for the cash rate, but at the same time, they've announced quantitative easing, which means they're bound not to hit the target. What kind of target is that? One of my colleagues, one of the tutors on my first year course at uni, sent an email to the RBA, and this was the reply that he got to that email. Thank you for your email. The Reserve Bank is not offsetting the purchase of government securities. What that means is the RBA is buying these treasury bonds, Commonwealth government bonds and state and territory government bonds from the private sector, putting additional exchange settlement reserves into the system. And as we've already seen, because I've shown you the chart, increasing exchange settlement account reserves, deliberately creating excess reserves in the system, which prior to the 18th of March would have been unthinkable in Australia. And they knew what they were doing. The increase in settlement balances is also expected to change the way the cash market operates. In other countries, where there have been large increases in balances at the central bank, the cash rate equivalent has drifted below the target. So they announced a target for the cash rate, and at the same time, they announced a policy which was bound to drive the cash rate below target, and they knew it would. And transaction volumes in the cash market have declined. I hesitate to draw a demand curve and to put a pair of axes up in a presentation like this, but let's see whether we can make sense of it, shall we? Remember the corridor system. You had a target for the cash rate. There was a rate of interest at which banks could have an overdraft from the RBA, which was 0.25% above this. There was a rate of interest which was 0.25% below it, which was the rate the RBA paid on exchange settlement account balances. Remember, they cut the target for the cash rate to 0.25%. They didn't cut the rate of interest they paid to zero. They cut it to 0.1%. Now, if previously, in order to meet the demand for exchange settlement account balances, the RBA had had to supply a level of exchange settlement account balances denoted here by ESA1, then the demand for cash in the banking system and the supply of cash in the banking system would have been equal at the target cash rate. And as I've mentioned before, all you need to do is announce a change in the target cash rate, and the actual cash rate will change in line with the target. These are very uncertain times. So even before the change in policy, even before the implementation of quantitative easing, there'd been an increase in demand for exchange settlement account balances from the banks. If the RBA had bought government bonds, but only to the extent that was necessary to increase the supply of exchange settlement account balances in line with the increase in demand for them, then again, the cash rate would have stayed at the RBA's target of 0.25%, but they haven't done that. They've pursued a target for the interest rate on 3-year government debt. And that's meant a big increase in the supply of exchange settlement account balances in the system. So there are now excess balances in the system. And those excess balances in the system, for the reasons that I was just saying, start to drive the cash rate down. If I'd shown you the RBA spreadsheet, you could have seen basically it's gone down from 0.25 to 0.24 to 0.23, all the way down to 0.15%. That's where the cash rate is at the moment. The RBA's target for the cash rate, the official cash rate target, and the cash rate that the RBA's own policy of quantitative easing has delivered have now a big gap between 0.1%. And if quantitative easing continues, you can expect the supply of exchange settlement account balances to increase in a way which will drive the cash rate down to 0.1% eventually. And we'll eventually get to a situation where none of the banks need to borrow exchange settlement account funds overnight. So the cash market will just disappear. You can see what's happened to the number of transactions taking place on the overnight interbank market. Prior to quantitative easing, there were nearly 40 transactions taking place a day. there were over 100 authorised deposit-taking institutions in Australia, and some of them, remember, would have had excess exchange settlement account funds. Others would have been short of exchange settlement account funds, and these are transactions taking place each day where banks with excess funds were lending to banks with a shortage of funds. Post quantitative easing, what's happened is that gradually the number of these overnight transactions has fallen and the scale of the transactions has fallen as well. So what we're seeing is gradually the disappearance of the overnight interbank cash market. We're moving towards a situation, you might say, where the cash rate, the way we've always defined it, really ceases to have any meaning, because there won't be any banks borrowing overnight from other banks, because they'll all be stuffed full of exchange settlement account balances as a result of the RBA putting additional electronic cash into the system by buying government bonds. You notice I mentioned at the beginning, they haven't just been buying Commonwealth government bonds. They've been buying state and territory government bonds too. The purpose for doing this is to prevent the gap between the interest rate on state and territory government bonds and on Commonwealth government bonds skyrocketing during a period of time when obviously state and territory finances are taking a terrible hit, and state governments are having to issue a lot of additional bonds, and investors are becoming more risk averse. So we've seen what's on the vertical axis here is the gap between the interest rate that the states have to pay and the interest rate the Commonwealth pays on 5-year government bonds. You can see it jumped upwards when the crisis really hit, and when Australia was partially closed down, and state and territory government bonds were obviously going to be having to meet enormous expenses, and at the same time see their tax receipts crash. And remember, they're not monetary sovereigns, there is default risk associated with them. They would have been in trouble in terms of their financing costs were it not for the fact that the RBA has now bought $8.5 billion worth of their bonds. What that's done is it's kept this gap down so that actually the interest rate that the states are paying on their debt has remained more or less constant, because the reduction in the interest rate on Commonwealth government debt and the increase in this spread, the gap between the interest rate on Commonwealth government and state government debt has remained constant. That's, sorry, it's increased by the same amount. That's the result of the RBA backstopping the states, which it's doing at the moment, keeping their financing costs down. That too is something which would have been unthinkable prior to about 3 weeks ago. The Treasury is still selling bonds on the primary market. It says things aren't that complicated. Maybe I should have said things shouldn't need to be that complicated. What we've got at the moment is a situation where the Australian Office of Financial Management, the Treasury, is continuing with its practice of selling Treasury bonds to investors on the primary market by auction in order to cover the government's deficit spending. Remember, the purpose of that before the 18th of March was to drain excess reserves from the banking system. So the government is engaging in deficit spending. That's putting additional reserves into the banking system. The Treasury is then selling government bonds. That's taking those reserves back out of the banking system again. The RBA is then buying those bonds, or very similar bonds, on the secondary market from the investors who bought them from the Treasury. And that's putting the reserves back into the system once more. It's ridiculously complicated, because when you get to the end of the story, it's as though the Reserve Bank was just typing funds directly into the official public account, into the Treasury's account. It would be much simpler for the Reserve Bank just to buy the bonds from the Treasury direct and never to issue them at all. It's the same final effect. Or for the Reserve Bank just to type funds into the government's account and just give the government an overdraft, which is what the Bank of England is doing for the UK government at the moment anyway. The overall balance sheet of deficit spending combined with quantitative easing is equivalent to outright monetary finance. If the government spends more than it taxes and then issues bonds to the private sector, and then the RBA buys those bonds back from the private sector, that has the same final impact of the RBA just typing funds into the government's account, into that cell in its spreadsheet, which represents our monetary system. This doesn't change anything. Quantitative easing doesn't change anything in terms of funding government spending. Our government is a monetary sovereign. It's a currency issuer. It can't run out of its own currency. But what it does do is it makes clearer what MMT economists have said all along. Government net spending, deficit spending increases the supply of net financial assets to the private sector. It increases what I like to call the net money supply. It provides money to the private sector, which the private sector hasn't had to borrow into existence. You can sell bonds, if you like, in the primary market with one hand of the consolidated government sector, the Treasury, and buy them back again in the secondary market with the other hand of the consolidated government sector, the RBA. But really, the whole thing is pointless. Beyond making clear what has always been true, which is that the Australian Commonwealth government cannot run out of Australian dollars, given that it's a monetary sovereign currency issuer, quantitative easing achieves very little. What does it do? It reduces long-term interest rates. Is that going to encourage businesses to issue a lot more corporate bonds and go ahead with a lot of additional investment at the moment? No. Does it encourage banks to lend more? No, and at the moment, there's not many credit-worthy borrowers they've got to lend to anyway. It might have a portfolio effect on the stock market, prop up share prices, make people feel a bit wealthier and get them to spend. To the extent it does that, it has adverse consequences for the distribution of income and wealth in Australia, but there's very limited evidence that it does that significantly either. So given that quantitative easing does very little other than just make explicit that the government can engage in fiscal policy without any financial constraints, which we already knew, why do it? Well, because there isn't anything else that the Reserve Bank is allowed to do. If you are a central bank and you believe that the government's fiscal response to an economic crisis is not significant enough to support the economy, then you might cut interest rates down towards zero because you're not allowed to do, you can't do fiscal policy. All you can do is cut interest rates. When you reach the zero lower bound, you might engage in quantitative easing to put downward pressure on longer term interest rates and support financial markets. That in itself is not doing very much to support the well-being of ordinary people. It's not doing very much to support the real economy, to support employment, but it's all you're allowed to do. Then you created a situation which people might very easily be confused about, because the Reserve Bank now owns a lot of government bonds. Remember, they bought sort of $45 billion worth in the last 3 weeks. Now, what about the payment of interest on those government bonds? Our government, the Treasury, pays interest to the Reserve Bank of Australia on the government bonds that the Reserve Bank of Australia now owns. But that interest then becomes part of the profit of the Reserve Bank of Australia. And the Reserve Bank of Australia does not retain its profit. It pays its profit out in dividends to its shareholder. Well, guess who its shareholder is? It's the government. So the dividends go back into the public account again. This nonsensical charade is pointless. As I think Bill Mitchell said on a podcast he did with Alan Kohler recently, you're just taking funds out of your right-hand pocket and putting them in your left-hand pocket and then putting them back in the right-hand pocket again. Government debt held by the RBA doesn't really exist at all. The repayments on that debt just involve moving funds from one pocket of the consolidated government sector to the other pocket. The RBA may as well just be typing funds directly into the Treasury account for the Treasury to spend into the economy. It would be much simpler, doesn't really matter how you do the accounting. Issuing Treasury bonds to the private sector and then using quantitative easing to buy those Treasury bonds back again is a pointless activity. So what would I do? I rather like the fact that in a TV program, somebody called me a renegade economist the other day. What would a renegade economist do? Get fiscal policy right. The fiscal response of the government to our downturn has been insufficient so far. That is not to say that it's not been better than most other countries around the world, but it's been grossly insufficient. They're failing us. We need more support in the private sector. People's incomes need to be closer to what they normally are. There are people who are struggling with debt repayments and with rent payments on their home. And there are people who are struggling to maintain their standard of living because they've just seen their incomes crash as a result of losing their jobs or as a result of being forced onto the JobKeeper's payment, which is a much lower amount of income than they're normally used to. So I would have I would have been moving the government's fiscal balance much further into deficit than it has been moved. In the future, the fiscal balance, of course, should be set at the margin by the size of the job guarantee, but I'm not talking about a job guarantee for the moment. I would issue no more Commonwealth government debt securities ever. Government net spending should just be allowed to increase the amount of funds in banks' exchange settlement account balances. There's no need to withdraw those funds again, as is being demonstrated at the moment and has been demonstrated in Japan and the US and the UK and elsewhere down the years. Increasing the amount of funds in bank exchange settlement account balances is not an inflationary thing to do. And if you want benchmark interest rates right the way across the yield curve, if you want to offer the private sector default risk-free interest rates across the yield curve up to 10 years or further, then by all means, just offer saving accounts to everyone at the RBA at low and stable interest rates, but consign Australian Commonwealth government debt securities to the dustbin of history because they make it appear, the fact that the government issues bonds confuses people. It makes it appear as though they've got something in common with corporate bonds or even state government bonds, something in common with the debt of institutions which are not currency issuers and face financial constraints and could face insolvency risk. Of course, that's not true as far as the Australian Commonwealth government is concerned. So the fact that the existence of Commonwealth government bonds confuses people and makes people think that the government could go bust, that the government genuinely does face a financial constraint, means we really should scrap Commonwealth government debt securities. We don't need them. And of course, under those circumstances, we can forget about quantitative easing as well. And that's it, really. I'd be happy to answer any questions that people might have. I hope I haven't bored you to death along the way. There are lots of questions in the Q&A section. Let me just stop this share.
Okay. Hi, thank you, Stephen. That was great. All right. We have 25 questions in the Q&A, but we have. I've asked if people want to ask their questions live, if they raise their hand. We have one person who digitally. There's a little raise your hand option. We have two. I'll go to Tuan first. So I'll just now allow you to talk. There you go, Tuan. We can unmute you. Oh, sorry. What did I do then? going back to allow to talk, unmute. Okay.
Thanks very much for sticking with it, by the way. I see there's lots of participants still on the list there. It's
okay, so
quite a dry thing to be talking about on a Saturday afternoon, QE. Anyway.
Okay, Tuan, you're ready to go. So do you want to ask just one question? And we've got, looks like 3 other attendees who'd like to ask live as well. Off you go,
Okay.
Tuan.
Okay. Hi, Stephen. How are you?
I'm very well. How are you?
I'm good. Thank you. Well, my question is really, I'm getting a little bit confused about one of the roles that I perceive of quantitative easing is that, as we know, one of the biggest problem in such a downturn is that the failure of payment, i.e., when you go bankrupt, then you don't pay your loans, or and you don't have any income, you stop paying your rent and so on. And so, if it goes all the way up to the the payment chain, it will affect the bank, because the bank is the backstop of any of those sort of the payment system, really. So I wonder whether, if quantitative easing has got any role to play in facilitating the the balancing of the inflow and the outflow of money.
No, quantitative easing doesn't do anything as far as that's concerned. Yep. It's, at least the way it's done in Australia, it's just swapping one safe financial asset for another.
Okay.
That's all. So all you're doing is buying government bonds from the private banks, and those private banks don't own those government bonds anymore. Instead, they own an electronic balance at the RBA. So you're just changing a term deposit at the Reserve Bank, which is what government bonds are effectively, for a transaction deposit.
Okay.
Nothing. It doesn't help the banks with losses that they might have made on their
it's just, so it's a
lending.
bit
It does nothing as far as that's concerned.
So so it's a little bit, it's unlike the Fed. What they're doing is that basically they've been pumping into or putting in all kind of swap sort of credit line, for between the various banks and so on and so forth, to ease the credit squeeze, for the US dollars, as far as I can see. So what sort of mechanism would that be, if it's not quantitative easing?
Well, the Federal Reserve's quantitative easing also involves qualitative easing, in that they've been buying private sector debt securities, and they also buy mortgage-backed securities which have been issued by the government-sponsored enterprises, Fannie Mae and Freddie Mac, as well. It's a little bit more complicated. In the Eurozone, the European Central Bank buys corporate bonds as well as government bonds. In the UK, that's true, and they've bought some mortgage-backed securities as well. The Bank of Japan has gone the furthest of all. The Bank of Japan buys, they don't buy shares, well, they buy shares in things called exchange-traded funds, which means indirectly they're buying shares across the Japanese stock market. But in Australia, quantitative easing is just what you might say is a very standard, straightforward. The only even slightly surprising thing they've done is they've bought some state government debt. What that has done is it's helped the state governments finance themselves, because state governments are not currency issuers. But they haven't done anything to help banks with losses that they might make as a result of people defaulting on loans. No.
Okay, thank you.
That's all right.
Okay, so we also have Les Allen. So Les, I'm just going to allow you to talk now. Are you ready? Okay, and unmute. Let's see.
Rather you doing this than me.
I think I've got it right. Les, I just want to see, have you unmuted? Yeah. Yep. Okay, there we go.
You unmute here.
Yeah, okay, you're unmuted now. Yeah. Go ahead.
Thanks, Jane, and thanks, Stephen, for a very interesting talk. My question is, during the global financial crisis in 2008, what basically did Kevin Rudd do to stimulate the economy?
Well, that was something different. I mean, Kevin Rudd engaged in deficit spending, which our government is doing at the moment. Indeed, they're doing much more deficit spending than Kevin Rudd did. But the extent, the impact of the global financial crisis on Australia's economy was much smaller than what we're facing at the moment. That's fiscal policy. When the government spends more than it raises in taxes, then the government is running what we call a fiscal deficit. What people often forget is that a government's deficit is everybody else's surplus. So what Kevin Rudd did during the global financial crisis was to support Australia's economy by engaging in some deficit spending. Part of that involved just putting funds directly in our bank accounts, if you remember. And then there was the package where he engaged in spending on which involved school hall building and insulating homes, and there were some other elements to it as well. But the government deficit, the government had been running a small surplus before the global financial crisis. The government deficit, I think, went to something like 6% of GDP then. About half of that was the government's tax receipts crashing because the economy stopped growing. The other half of it was a very limited stimulus package, which just limited the extent to which unemployment increased, and it was a very important thing to do. They should have done a lot more of it. Scott Morrison is doing deficit spending at the moment, of course. He's doing what would have seemed like an enormous amount of deficit spending prior to the crisis. The government is going to end up with a deficit which is well north of 10% of GDP, which would have seemed a huge amount before. It's a bit more than the US deficit following the global financial crisis, or the British deficit following the financial crisis. But given the scale of our problems, they should be doing more deficit spending than that. We don't have any inflationary issues to deal with at the moment. And the important thing is that the government doesn't have a financial constraint. It is a currency issuer, and at the moment it should be taking advantage of that on a larger scale than it already is. I'm not quite so harsh on them as some people, because although our government is not doing what I would have liked them to do, they are doing much more than most other governments around the world. And we just have to compare ourselves to the US, for example, where not only is the so-called stimulus package too small, but it's all biased towards rich people. It's not hardly supporting ordinary people at all. We're much better off than they are. But that's fiscal policy. That's the job of the government. It's it's nothing to do with the Reserve Bank, apart from the RBA just being involved in the facilitating transactions between the government and the private sector. The RBA is not allowed to engage in deficit spending. That is something that the government does, and the government can only do subject to parliamentary approval. That's why they brought all the parliamentarians back, so they could vote on the support package that some people like to call the stimulus package, the job keepers payment, and the job seekers supplement, and all the rest of it.
Thanks, Stephen.
That's all right.
Thanks, Les. All right, so next question is from, I'll take the next question from Eshra. So I'm just going to allow you to talk now, Eshra. If you'd like to also have your face be live to ask the question, then you can start your video yourself. We can't do that. So I'll just unmute you now, and if you want a video as well.
That's what I came on to do, but that's all right.
Okay.
I'll disappear again.
Okay. Hello, Eshra, you go ahead.
Yes, hello, how are you?
Good.
Thank you, Stephen. First of all, it's been very enlightening. So just have a broader question in mind. So quantitative easing, I mean, it's a monetary policy, extreme monetary policy, if I may. And isn't that kind of a mechanism in that would Keynesian economy would probably do? So my question was just wanted to ask your opinion from the renegade economist point of view. So why is whenever there is a financial crisis, this Keynesian economy rejuvenates and then it goes away and it's not really being maintained in the normal real ways? That's all.
Well, that's a complicated question. First of all, Keynes wouldn't have recommended trying to use monetary policy to deal with an economic crisis anyway. He said it's like pushing on a string under these circumstances. Just cutting interest rates, or even cutting long-term interest rates, is not going to work when there's nobody that has an incentive to borrow that's also creditworthy from the point of view of lenders, and so is going to want to borrow. Why does Keynesian economics come back every time we have a crisis? Well, it should never go away, really. That's the economics of Keynes and what people have over the last 50 years come to call Keynesian economics are not the same thing. Lots of us who are modern monetary theory economists, not all of us, Bill wouldn't like me saying this, for example, but lots of us would also call ourselves post-Keynesians. If you're a post-Keynesian economist, that means that you try to remain faithful to what Keynes wrote about in his famous book, The General Theory of Employment, Interest and Money, that was published in January 1936, and his subsequent papers and the work of his colleagues and students after he died, and his contemporaries like Michel Kleski. That's a very different approach to economic management to what has sometimes been called Keynesian economics. So you sometimes see people use the term Keynesian to refer to the notion that you should be cutting interest rates in order to create more demand when there's a lack of demand in the economy, and that interest rate cuts are the way to do that. No, as far as what I recognise as Keynesian economics is concerned, it is the job of the government to use fiscal policy to ensure that there is sufficient demand in the economy to get us to non-inflationary full employment. That was how somebody called Aber Lerner, who was a post-Keynesian, interpreted Keynesian economics when he developed what was called functional finance in the 1940s. Keynes certainly believed the economy should be held at full employment. During the Second World War, it was demonstrated that economies could operate at full employment. And then after the Second World War, governments in countries like Australia and the US and the UK, especially Australia, actually implemented an approach to economic management which did hold economies at full employment for 30 years. Unemployment in the 1950s employment in those days. There was effectively full employment in Australia for a long time. And the government was, even though we were in a fixed exchange rate system, so there wasn't the freedom of action that there is now, the government ran fiscal deficits almost the whole time. Robert Menzies only ran a surplus, and it was a tiny one, once at the beginning of the 1950s. Other than that, there was deficit spending all the way through, and it was that deficit spending which was used to hold the economy close to full employment. I'm not going to try and talk about a job guarantee now, but our social and institutional structure today is not what it was in the 1950s. Our economic structure is not the same. We can't go back to then, but we could use an employment guarantee as discussed by Bill Mitchell in Australia and people like Pavlina Tcherneva in the US to enable us to use appropriate deficit spending now to hold our economy at a loose form of full employment, to address many of the inequities that we have in our economy, and to do so in a way which was not inflationary. But fiscal policy should be in the lead. If it was down to me, official interest rates would either be zero or close to zero and left there permanently. and I would deal with private debt through regulation. So the banks would have to be repurposed so that their function was not to finance speculation on financial markets and the property market as well, but instead their function was to support small businesses and to support the capital development of the economy. So we need to look at our banking system carefully, and we should be using deficit spending to allow the private sector to be in surplus, the private sector to net save and have stable balance sheets over time and maintain the economy at full employment while limiting inflation. That's the ideal. I'm not saying that there wouldn't be bumps and bruises along the way if we were to move to that kind of system, but that's the approach to economic management which modern monetary theory economists have been calling for more than 25 years now, and that maybe as a result of this crisis we're getting a little bit more airtime than we were before. I hope that I live long enough to see our economy organised in a way like that in the future. You know, that's really what we're working for. I'm not interested in being a famous economist. Mm-hmm. If there were lots of modern monetary theory economists in Australia doing these kind of talks, I would just be at uni doing my job. The only reason I do this kind of thing and go in the media is to push for those kind of policies and push for modern monetary theory as the appropriate frame for thinking about macroeconomics. And I started doing it basically because the only person doing it in Australia was Bill Mitchell, and you can't leave everything to one person. That's the answer. Long answer, sorry.
Thank you. So
thank you so much.
That's okay.
Yeah. Okay. Next person. We only got probably time for the next two questions. There's only two more. So I'll take Tom Sheridan first. So Tom, I'm just going to allow you to talk. If you want to video as well, then just you need to switch the video on your end. So you're ready to go. Ask your question, Tom.
No worries, thank you. It's actually, I'm watching it with Tom, it's Matt Crocker here, Stephen, but thanks for the chat.
Okay.
Anyway, and you've probably covered a little bit of what I wanted to discuss right now, but from my take, if I'm understanding it correctly, sort of in your mind as well, you know, the fact that the government has pursued a quantitative easing policy, is that almost without them being overt about it, sort of an admission that monetary policy has sort of reached their end to which it can be effective? And I think, you know, one thing, and I don't understand this fully yet, but talking about like a liquidity trap, and I know that's, you know, falls in the monetary policy world of things as well, but I was just wondering if you could maybe talk around that a little bit, and are we in a liquidity trap, and what that might actually mean? Thank you.
If I can avoid using the term liquidity trap, that is a term that was used in Keynes' general theory, and it has a technical meaning that I don't want, probably not worth going into at the moment. Do I think that monetary policy is out of bullets? Yes, I do internationally, but I do especially in Australia. And the reason why I think that especially in Australia is because through relying on household debt to power our economy, which we did from the mid-1990s onwards, especially to the global financial crisis, but to an extent since, it was that private sector borrowing that allowed the Howard Costello government to run a surplus while our economy didn't implode. But the consequence of that is that we now have the world's second highest level of household debt relative to the size of our economy. And I don't think there's really much room for the ratio of household debt to GDP to go up much further than it already has. So I think we were getting to a point already a year ago where monetary policy was out of bullets, interest rate cuts had done all they could do, and further interest rate cuts as you said, were basically a sign of defeat, really. The RBA kept saying, oh, we cut interest rates. It didn't work. We're still missing inflation on the low side. Unemployment's still higher than we'd like it to be. Let's try again. Oh, that didn't work either. Let's try again. Oh, that didn't work either. That's what they've been doing in recent years. And so, yeah, I never have had much faith in monetary policy being a reliable way to manage demand. But it is now obviously the case that interest rate cuts have gone as far as they can go. So short-term interest rates have gone down to zero. At the moment, quantitative easing is just pushing longer-term interest rates down towards zero as well. That won't achieve anything much either, because it's always fiscal policy that's in charge. Warren Mosler tells a nice story, or paints a nice picture here. He says, if in the central bank imagining that it's in control of the economy is like a child sitting in the passenger seat in the car with a toy steering wheel, moving the toy steering wheel about, whereas actually it's Josh Frydenberg that's sitting behind the actual steering wheel. It's fiscal policy, which is important in terms of managing demand in the economy over time. That's especially true now because of the very high level of household debt we have. There is literally nothing that the Reserve Bank can do to help.
Thank you.
Okay, thanks, Matt. Now we have one more question. That's all. So I'll hand it over to Kate Cooper. She's the last one with her hand up. Just allowing you to talk now, Kate. And if you want to, if you want to go video live as well, you can do that from your end.
I'll stay off screen, thank you. What I was wondering was, if the aim of modern monetary theory is to have full employment and not more than full employment, because that's an inflationary pressure, what happens with the balance of trade? How does that affect fiscal policy? Because if there's a surplus in trade, all well and good, but if it's the other way, if we have a deficit in trade, do we owe money in a foreign currency, and would that give inflationary pressure, because we can't deal with debt in a different currency the same way we can with Australian debt?
That's a very good question. It would have been an even better question before 1983, but it's a very good question now as well. Modern monetary theory, just taking a step back a bit, doesn't really have an aim. It's an approach to understanding how the monetary system works, and so understanding macroeconomics. It happens to be the case, particularly in Australia, that modern monetary theory economists, and there are not many of us, are all progressives. So we are in favour, given that we think we understand how the monetary system works, we're in favour of using that information to try and deliver non-inflationary full employment. That's where the job guarantee comes in. But you could be somebody who didn't care about unemployment at all, and you could still understand modern monetary theory. It's just a detailed description of how monetary systems work in countries like Australia. The other part of your question is relevant to to how the monetary system has worked in Australia since 1983. Since 1983, we have been full monetary sovereigns. What that means is we obviously have our own currency. The government spends that currency into circulation, taxes some of that currency back out of circulation. The role of taxation is not to pay for government spending, it's to limit the ability of the private sector to spend, so that you can have government spending without it being inflationary. As far as the balance of trade is concerned, I guess I could first of all point out that Australia's current account deficit was at its highest level ever during the John Howard government, when the government was running a budget surplus. So there's not a simple relationship between the government budget balance and the country's trade balance internationally. But the second thing to say is that last year, in the second half of last year, Australia's current account balance went into surplus. Prior to that, it had been in deficit continuously since 1974. Now, you might think, does that mean we have a lot of foreign currency denominated debt? As it turns out, we don't. As it turns out, Australians, or Australia as a whole, private and public sector between us, we have net financial assets in foreign currency. How is that possible? It's possible because the rest of the world over the last 40 years or so has chosen to hold a lot of Australian dollar denominated financial assets. The rest of the world holds a lot of Australian government bonds. Sure, we don't rely on them to buy those bonds. If they want to hold safe assets denominated in Australian dollars, they'll buy Australian government bonds in the secondary market. We don't ban them from doing that. About half of all government bonds in Australia, a bit more than that until recently, are owned by foreign investors. So no, we're not borrowing in foreign currency. What's the risk of deficit spending? Well, deficit spending, if it pushed the trade deficit up, potentially it could cause currency depreciation. But again, in the last 30 years anyway, there's not been a simple relationship between the trade balance and exchange rates. We've had the Aussie dollar appreciating when we've been running current account deficits and sometimes depreciating too. Recently, we've had a current account surplus, and yet the Australian dollar has depreciated a lot in recent months because almost the whole of the turnover on the global foreign exchange market these days in currencies like the Australian dollar is to do with investors moving funds from currency to currency, from money market to money market, from stock market to stock market. And trade in goods and services is a tiny fraction of the total turnover of the foreign exchange market. But if a trade deficit did cause some downward pressure on the Australian dollar, again, good news, we have a flexible, diversified economy. Our dollar against the US dollar has been all the way down to 49 US cents per Australian dollar and all the way up to 1.1 US dollars per Australian dollar in the last 20 years, with very little impact on domestic inflation for a variety of reasons. So sure, I guess if deficit spending pushes the trade balance into deficit and the trade deficit up, if that causes speculators to sell the Australian dollar, if the dollar then depreciates, then that can put some upward pressure on the prices of foreign goods and services, which are priced in foreign currency. They cost more in domestic currency. That is not in itself going to cause inflation in Australia, but it will cause a one-off increase in the price level. But we can manage that. We've got plenty of experience of that actually over the last 20 years because there's been a lot of exchange rate volatility. It's up to us to manage our macroeconomic policy to continue to hit or be close to hitting our inflation target and to get full employment. But no, that's not something I'm scared about. And no, we don't have a lot of foreign currency denominated debt. Even our banks that have sold a lot of bonds to foreign investors have been forced by APRA to hedge their exchange rate risk. So even our banks are not exposed to exchange rate risk like that.
Wonderful. Thanks very much for that explanation. I appreciate it.
Okay, I think that's all for now. There's no other questions. So I'll hand it over to Joshua to sign off and to thank everyone. And thank you, Stephen. I'm going to sign off.
Thanks,
and
see you.
Here's Joshua. Bye.
Okay, well, thanks for that, Jane. And yes, thank you as well, Stephen, very much for, again, presenting to all of us on a lovely, well, Melbourne's not a particularly lovely Saturday afternoon, but I hope it's lovely where you are in Adelaide.
It's just stopped raining, actually.
Again, for anyone who is watching, we have had our previous lectures recorded and put onto YouTube. So if you're interested to learn more about monetary theory, tongue-tied, jump onto YouTube and search up Modern Money Australia. You'll find those videos. We will be running another seminar later on in May as well, which we'll put details up online in due course. And with that, I'd just like to thank everyone who's viewed this presentation for jumping online and watching as well. We really appreciate that. And I hope everyone has a lovely day. Thank you. Bye.
Thanks. Bye.
Thank you. Bye.